All right, we're back. Welcome back, chat. Another Monday night live stream. Already got chat rocking and rolling tonight, too. We got Chris and Larry introducing themselves to each other. Larry Summers, always glad to have you here. And yeah, another exciting week in the books and another exciting week in front of us. So let's strap on in for a good stream tonight. Where do I want to begin? Let's start with the fact that on Saturday, I was on Steve Keen and Friends, had a great discussion with Professor Steve Keen and the rest of the gang there. And I thought it went really well, too. I'm really glad. I mean, if you watched it, one of the things that I'm very passionate about is deep learning and building up deep learning and AI models to better understand markets. And oftentimes when the MMT discussions come up, especially when I'm on various podcasts and stuff, the host wants me to but they really want to make sure that the listener has a good grasp of what MMT is, and so it's not throwing them off of the rest of the discussion, that being the listener off of the rest of the discussion, just because they have kind of a misunderstanding of what MMT might be. And so oftentimes the discussion on these things stays in just the realm of, what is MMT? And I'm always glad to discuss that. But like my passion is really the data and the applied side of applied MMT. And so I was glad that it was able to go there, and I can kind of express some of those thoughts, ideas. So we can definitely discuss some of that tonight. Chat, I gotta be a little honest. I have some things prepared. We can go over the Steve Keen and Friends podcast, and there's some things that I want to follow up on. But if you guys have questions, tonight's the night. I will certainly hit those up and use those. Some of the things I might want to do tonight is I'm prepared to do a little coding. If you guys want to see some things, project I've been working on, and I need to kind of take the next step. I don't know. I'm willing to start taking these live streams wherever everyone wants to take them. I want to make them both like meaningful and impactful, but also give you all the time and opportunity and place to kind of have a spot to chat and whatnot too. I think that's I've noticed that we're building a little community here, and I think people appreciate the time to just chat. So if I just do some work and kind of speak it out loud what I'm doing, then maybe chat can keep on going and you guys can get something out of it. So that might be on the docket for tonight as well. Adam is out tonight. Obviously, I'm here alone, so it'll be a solo stream. He's enjoying himself at a Tigers game, so go Tigers, go Tigers. I'm also trying a few other things tonight. You guys can't see this, but I'm going to try and launch some shorts and a TikTok as well. So I'm recording this entire thing along with the stream in vertical. I'm looking at my other monitor right now as I record, just to make sure that it's looking all right. And so maybe some of the stuff might go up on shorts or TikToks. My 6-year-old, almost 7-year-old daughter was getting quite the kick out of the fact that I had my OBS up in vertical and I was making TikToks the other day. So getting prepped. But I do think there are some kind of TikTokable or shortable little clips from here that I'd like to capture and get out there. What else? I'm seeing chat kind of say hello. Chat, man, make sure you hit that like button. If you're just chilling out in chat, it would be much appreciated. All right, let's go through the lineup here. We got Chris. Welcome. You had a question right out of the gate, which I will answer. And speaking of questions, if you are, let me make sure the stream is live on YouTube. If you are on Twitter watching this, I'll be streaming to Twitter, but if you are on Twitter watching this, make sure, and you want to interact, make sure you jump on over to YouTube. It's going to be much easier for me to interact. I tried to do the Twitter discussion chat and the YouTube chat at the same time, and it just didn't go together very well. So it does look like we're live on on Twitter, so I'll keep on with the stream. Anyway, Chris, welcome. We got Larry Summers back in the house. Oh yeah, and then the other thing too, I don't know if I mentioned this or not. Make sure if you have a question, put question in chat if it's directed to me, especially if I'm like on a roll and it's not like I'm not looking at chat. Make sure you put question in it, and that it highlights it for me on my end, and I will make sure and get to it. We got Gavin, welcome. Brian, welcome. Appreciate you dropping by. Echo Skeleton, howdy. MC, what's going on? We got Bully Pulpit 2000. Are we placing bets on the next Fed move on interest rates? I'm guessing higher. At the very least, I'm guessing not lower. Let's go that route. I'm also realizing too. Let me make one quick modification here to make sure I can do the chat overlay. Get that URL in there. All right, guys. When it's solo, man, I forget the checklist, and forget to go over everything. I was also just kind of prepping tonight, late into the. There we go. It's operating. Yeah, actually, you know what? Let me actually just pull up. I am a little curious. Oh, speaking of which, did you guys see the Fed Nowcast? Oh my goodness. Oh no way, chat. I'm not. This is not clickbait. This is legit. Hold your frickin' horses. This is unbelievable. No way. Oh my goodness. No effing way. Do you see that? The current target range, 525 to 550 basis points. It is now a statistical possibility based on Fed funds futures that we might get a hike in May. Wow. Wow. I mean, listen, for as long as, we can look at the historical, but for as long as I've been tracking this, we have not seen this. Wow. That was a stunner. Oh, I honestly, I did not see that coming. That's a big change. All right, we're going to go to June now. We're going to see if there's a chance. There is the tiniest of chances for a June hike. How is this possible? Oh my goodness. Wow. This might be tweetable after the stream. This is stunning. This is honestly stunning. I did not realize. Bully Pulpit, man, thanks for pointing this out. This is really cool. Jeez, oh Pete's, man. Another victory lap for myself. My legs are going to get sore, man. I can't keep running like this. This is wild. Okay. Let's go to the historical probability here. And see that, yeah, the June, I think we pointed this out during the last stream, the June hike, at least the June flat has stayed, the June no cut line, I guess, has remained right around this 40% mark, but definitely ticking higher. All right, that was a bit of a stunner, to be quite honest, that there's now actually a possibility. It ain't gonna happen. I highly doubt it's gonna happen, but at the very least, there is the slightest possibility of a rate hike now being priced in. I don't see it on the historical, so it must happen tomorrow. All right, let's get back to chat real quick, and that was crazy to me. Transition. All right, curate that Gen Z audience. You know what it really boils down to, MC, is my understanding is YouTube is really rewarding shorts and channels that have shorts. So I just got to get into that game. Charles Grip, what up, dog? I'm back to I'm assuming, lay down the Austrian law. I assume, yes. Yeah, welcome back, man. Haven't seen you in a while. Glad you are back. I've had some good interactions on the Twitter sphere, the X sphere. What a dumb name. You know what the worst part about renaming Twitter X is when you're just trying to do something simple like Google, how do you do something on Twitter, right? It's not how do you do something on X, and X is just the X is the proverbial variable for anything, right? And so you can't search for how to do anything on Twitter now. It's so dumb. When I was trying to figure out how to do the multicast, both the streams, and then put them on X and on YouTube, Twitter and YouTube, it was really hard to figure that out. It wasn't hard, but it's just dumb. It's dumb that has to be like how you search now. So start time is now 4:30 Mondays now, so it'd be 7:30 my time. I was ready to go at 7:30, so I put it on early. Adam wasn't going to be here tonight, and we'll just kind of go live when I can go live. And like I said, I plan on doing these more. I feel like we can get into a rhythm, and it's easier for me to think out loud and just go with the flow. So that's kind of my it's kind of my game plan, and we'll just kind of go live when I'm ready. But yeah, what I think I'm going to do is like start doing the streams whenever I can. But then we'll keep like the 8 o'clock, especially if Adam's here. We'll keep that 8 o'clock window every Monday, and then I'll probably like brand the stream thumbnails differently, so you guys know when it's like that stream with Adam, and then when it's just kind of more casual, laid back discussion with me. So let's keep going down chat here. GDP coming in hot. Yeah, that's what I wanted to talk about. GDP, man. We got the what am I pulling up here? Twitter. I'm pulling up Twitter. I'm gonna pull up the Atlanta Fed. Let's see if I can ATL. And their nowcast came out today. Let me make sure that I'm pulling up the right window, and we'll move this on over. So they came out with their nowcast today, and whoa, and this is real as well. This is not nominal GDP. This is their estimate for real GDP, which means like nominal is going to be almost double this. It's wild. So GDP expectations now is absolutely screaming higher. What I find of kind of equal interest here is the fact that one, blue chip consensus over the last what would this be? Is that December 2022? Is that what that is, or is that December 2022? So it would be the last 3-4 months here. Blue chip expectation. Okay, that's okay. I'm reading this correctly. It's to the end of March from December. So that would be from the end of December. So the last 3 months here, blue chip expectation, the consensus is starting to converge on where the nowcast is actually at, and that continues to push higher. Anyway, point being, GDP coming in very hot, continuing to outperform the consensus guess. And this is what's important. So many people miss this, especially kind of the reply guys in my Twitter, right? They'll come up with ad hoc reasons after the fact as to why there was some surprise in data, and they'll say, well, everyone knew XYZ. This isn't a surprise, but the point is we continue to get better than expected prints on like GDP, or hotter than expected prints on inflation. It's always where the print is relative to expectation that actually matters, because if you're consistently, like if you're the one that's making the guess as to where reality is going to end up, and you're not with consensus, and then the actual comes with your guess and it's better than consensus, then that means you've obviously discovered some sort of exploit that no one else is aware of. And so No surprise to me that GDP is coming in hotter than expected here. What I'm interested in, though, and I gotta dig into this one of these days, is everything that goes into the GDP Nowcast and overlay that. Because I think Deep MMT could, like, just, I mean, it would work perfect with something like GDP. So I think we could do like a Deep MMT GDP version, and then maybe also do like a GDP forward future cast based on the features of Nowcast as well. Anyway, coming in hot, man. Coming in hot. GDP. We are, And to the rest of the world is just realizing what we've realized as well, that growth is here to stay. And it's kind of interesting. I've got this tweet queued up for the 16th, and that'll be, I think, 15 or 16 months ago on the 16th of whatever month that was. Whatever month it was, months ago now, whenever it would have, either way, the end of 2022, I think it was December, it must have been, I made my argument that we were going to see a very bullish 2023 and took obviously a bunch of ridicule for it from almost everyone, but it'll be the anniversary of that tweet, and yeah, lo and behold, the rest of the world has figured out what we've all figured out here, which is those higher rates. Those higher rates do, in fact, contribute to expansionary economic activity, which is, and again, to jump back to the Prof. Stephen Keen's discussion, which is one of the things we did discuss, and we had a bit of a disagreement on in the discussion. And by disagreement too, I'm willing to not be right on the whole interest rate thing, right? Like it doesn't. I think probably the way I should put it, and the way that I kind of feel about the whole interest rate thing is I just think that what I do know is that the mainstream has it wrong, right? And they have it wrong just because structurally at the very outset, where the mainstream gets it wrong is the whole loanable funds thing. I mean, from like loanable funds onward, they're going to get it wrong, and all the implications thereafter. I think I discussed this in the last stream. Stephanie Kelton posted an article that Scott Fulweiler responded to from the methodology the CBO uses, or the concern the CBO has for the debt going forward, and just how much the mainstream is reliant on just terrible macro understanding. There's no borrowing from the private sector to fund government. I mean, that's what it all boils down to. And if you just work out the very simple math, the very simple accounting of how a country who spends its own currency works, when the government spends, that's actually adding financial assets to the private sector. So it's a crowding in event, not a crowding out event. And then every implication thereafter of that is wrong. That being their theory, right? So I mean, every implication of a crowding out event is not applicable because the crowding out never actually takes place. And so literally almost everything they have backwards. I mean, I know it sounds crazy to say, but the good news is we were able to test it out over the last 18 months, 2 years. Actually, speaking of which, another thing, it's been 2 years to the day since the yield curve inverted. Let me bring that back up. I tweeted this out. It didn't get as much traction as the rest of that. I felt like I was a former president tweeting today, but the yield curve. 10-year, 2-year spread. The yield curve inverted 2 years ago. And obviously different yield curves inverted at different times. But April 1st, April Fool's Day, we had the yield curve inversion first take place. So it's been 2 years to the day, and here we are 2 years later with the Nowcast coming in at 3% real GDP growth. And potentially the Fed now staring down the barrel of having to hike rates even more. God, oh man, you can't make this stuff up. You can't make this stuff up. Speaking of Twitter, that was one of the things I tweeted out this morning. Let me do this. I'm waiting for it. Yeah. All right, macro bears. It's officially Q2 2024. No recession in sight. Growth stronger than expected. Inflation warm, but still in check. Employment robust. What's the play here? Are you still right and MMT just got lucky, or are you ready to update your theory in light of new evidence? That new evidence being hotter than expected, baby. Expected by a lot. I mean, that's a wild thing, right? Is the expectation a year and a half ago is that, right now would probably be like the best buying opportunity ever. Why? Because, we'd be in the dumps, right? We'd be at S&P 2,500. But instead, I don't even know how high the S&P, what is it, 55, 5,600? Where are we at? This thing just keeps ticking higher and higher. And clearly 50... Okay, 5,300. I guess I went a little high on my... I don't know why I thought we were close to 5,500. Maybe that's my next target. But either way, the stocks keep screaming higher. And yeah, I mean, this market looks great. But that being said, though, I guess I can talk briefly markets. We are hitting that spot where tax strains are going to start, and there is a deep drawdown that takes place in April. And let me do this real quick. Well, yeah, I need to reformat this on the site. I'm realizing this isn't going to show up right on stream. With the way the site is formatted here. Sorry. Well, yeah, just bear with me. It'll be all right. It'll be all right. So what this is again, this is over on AppliedMMT.com for members over there. And speaking of which, over at AppliedMMT.com, Adam did a great job of redoing the front page, and we have just a nice little spot where you can drop an email, and any of the articles we put out can go to that email inbox. And I know, like, the number one request is, like, Doug, I want to get in on this. $129 a month is a lot for the pro tier. We get that. We think it's a justifiable price at what's being offered there. We are working on some sort of mid-tier that is somewhere in between. We just want to make sure that there's you guys get it. I mean, we all have businesses and stuff. We just want to make sure the value is there. But that middle tier will be coming. What am I showing on the screen, though? Yeah. If you put your email in there, and that's something you're interested in, you'll get the email when we launch to that middle tier. So again, sorry, the way this works, I'm kind of compressing my window right now. So I apologize that the entire heat map here isn't on screen. But on the left is the historical seasonal heat map for, we'll just call it fiscal flow, right? It's a 10-day average, and what that 10-day average is. And if I just scroll down here, you can see we have the most we have the biggest deposits, effectively, right? We have the biggest negative flow taking place in April. So we're going to hit that time frame very, very soon here as we head into April and tax season approaches. And in terms of like a 90-day flow, which is another way you can kind of chop this. Let me do that real quick. Daily Treasury statement. This will show up a little bit better. If you chop it up by a 90-day flow, this is effectively where you cap out right at the beginning of March, and you start kind of the slow decline into that April drain that's going to take place. And my thesis really for the last month has been that we're a little bit overbought here. We're a little extended on the rally. Sentiment has been pretty very strong, and is now going to be at this point where it's not exactly going to align with flows, and that wouldn't surprise me if we go into tax season, you get a bit of a pause, or maybe even a little bit after tax season you get a bit of a pause because of that massive drain. Now, what's really interesting is actually like the historically the most volatile period from like a historical seasonality time frame is that September to October time frame. And I think the reason for that is that's a much larger drawdown. You can actually see this in the monthly comparable charts. That's a pretty steep, I should say steep drawdown in October, oftentimes a flat September, October, because of corporate taxes that come in September, and so oftentimes you'll see a pretty deep pullback from flows in September, which set up this this instability, and that is corporate flows that are taking place at that time, and that is our corporate taxes that are taking place at the time. And I think the reason that creates a lot more instability is because also at the same time that you're getting the big April tax flow, you're also getting all of the refunds coming in at that exact same time. So even though the flows themselves are very negative heading into April, there is at least a bit of it's almost like a redistribution time period, right? So it's the dynamics are a little bit trickier there, but suffice to say, definitely historically after the big tax drain in April, you get the buy in or sell in May and go away, like the whole summer pause period, and that certainly shows up. And the reason for that is just the big tax drain. So that is still very much on my radar. I do think we could end up seeing a bit of a pause here in the equity space. All right, I got to get catching back up to chat. I've been a little bit all over the place. I'm actually very far behind here. Let's see. Oh wow, a lot of chat came in. Give me a second here, chat. I'm gonna catch back up. Is this like the 3-body problem instead of science? Aliens destroy economics. You guys must be talking about something else. Oh yeah, you know what? You had a question at the very top. Hey Doug, could you expand on your latest? Yield plus intraday yield plus interest rate tweet, please? I am getting hints that between the lines there is endogenous exogenous money debate. Looking at them now, any inference? Let me make sure I'm referencing the right tweet. This is my Twitter. Yeah. I just want to make sure. 2 years to the date, the yield curve inverted. I hope you're talking the latest yield interest rate tweet. Was that it? That had to be it, right? Yeah, that had to be it. Okay. I hope this is it. If not, tell me in chat and I'll jump back and fix it, or whatever, respond to it. 2 years to the date, the yield curve inverted. Had the Fed not started hiking 2 years ago, we'd likely be had a recession. I guess in one sense, good thing the Fed has it backwards. Pretty much what I'm trying to say is, and I think my thesis all along, again, I'm going to use my own website, AppliedMMT.com, and the data that's available. This is why it's such a valuable tool, because there's so much data on there that I actually use every single day. I was joking when I finally got the whole dashboard done and put together with the guys, that I'm like, man, yeah, I like, it's all right there, very handy. Monthly Treasury statement, essentially deficit, right? Deficit spending, change in deficit spending here. Why do I think rates saved us from a recession? We just had a massive contraction in deficit spending in real terms. And it's really just what it boiled down to. And every time we've gotten that, we got a recession. And it's like, you know how like the monetarist and everyone else likes to look at, the yield curve inversion as like the batting 100% for a recession. This really is it, right? I mean, this is batting 100% for a recession call, but those rate hikes effectively saved us. And not only that, right? Okay, in theory, you could get a collapse of deficit spending, or I should say, really a contraction of deficit spending into what would be effectively surplus. In terms of the rate of change of deficit spending, you could get a collapse and you wouldn't necessarily need a recession right away, right? I mean, that's what took place heading into the dot-com bubble. But we also had at that exact same time kind of the peak of the debt cycle at that time as well. So if I pull back up the Fred here and I type in BIS private, if I go back to here, BIS private, the debt, and I'm going to actually retype that. Private. Is it happier when there we go. That's the one I'm looking for. If we look at this and we look at the rate of change, so it's really the most important thing, right? Because it's the flow that we're comparing, or at least kind of honing in on, right? We had the big acceleration that happened into Q1. And again, it's that acceleration into deceleration that you have to worry about. And it's the contracting of the fiscal side that can oftentimes be enough to prick the bubble of the necessary acceleration that needs to be withheld to keep the endogenous cycle going. So we got both of those contracting at the exact same time, right? Now, every time we've had that, we've had a recession, right? We had credit contracting in 2006, 2007. We had the great financial crisis. We had credit contracting in 2000. We had the dot-com bubble. We had the same thing in the early 90s. This played out multiple times in the 70s, and then you go back and, I mean, effectively every single time after World War II until the financialization in the 1970s, a very similar look during that time frame. I just need to say this out loud. There's this really peculiar period between 60 and 70. I got to check that out. I got to see what was going on. I'm going to come back to that one. What was I going to say? Yeah, so we had both of these things happening at the same time, where we had fiscal falling off, contracting, the deficits contracting, and we had credit rolling over at the exact same time. And that leads to recessions. But it didn't, and the reason it didn't is because the Fed hiked interest rates, which flooded markets with, and they did that, April 2022, right? Yeah, April 2022. They saved the day. It flooded the markets with that interest income. I also think, and this was kind of part of the disagreement that Steve and I had, I also think that there's a possibility that it opened the door for banks to take on more risk, and that kind of helped things as well. So, maybe we didn't have a recession, right? Maybe we just got stuck in 2012 zone, right, or something like that, right, for a decade of mild growth. Maybe fiscal was sufficient enough. We'll never know, but we certainly wouldn't be where we're at today had that actually ended up playing out without the Fed cutting rates. So yeah, it's kind of my take on that. I hope that's what your question was and what I was alluding to in that tweet. All right. Remember, chat, either one, add me directly in chat if you have a question for me, or put question in the question, and then. Yeah. And then we'll make sure and respond. All right. Let's see. So bullish on Q2. I'm certainly not bearish at this point. Certainly not bearish. Pump up my debt servicing payments. Amen. What's up, Jango Geek? Glad you're here. I guess you've been here for a while now. I'm reading old chat. Yeah, man, I'm bummed you missed the show as well. It's still there. I'm quite happy with the views the show is getting. I am. Yeah, we'll leave it there. I'm very happy. I'm outpacing some prior guests, myself included, on views. So that's good. Jango Geek, you had mentioned to Steve that you had thought higher interest rates are the first step in the Minsky cycle, and Steve had responded that it's actually investment that does it, even in the absence of debt. Yeah, this is okay. So this is kind of where the disagreement happened. I don't know if it's a disagreement. I guess. I mean, look, Steve's the Minsky Master, right? I'm not going to I'm not going to say he has to have it wrong. I just find it peculiar that that it seems, and again, this is me just looking through my two eyes at charts. I mean, anyone can look at any chart and see whatever sort of pattern they want out of those charts, but it seems to me that for whatever reason, higher interest rates really kick off the spending cycle. And with that being said, though, a certain someone in chat messaged me directly, and I'll actually read those off. Let me just pull it up on my phone and I'll read it off. Ty and I were kind of talking about this, and I'm really curious to see what Ty ultimately comes up with when he finally publishes his Cindy Crawford supermodel. Ty's texting me even more here, but Here's how I'm going to summarize what Steve, or what I think that the argument is that Ty and Steve are saying is that there's just a lot more dynamics at play than just kind of one. My mic's coming after me, man. My mic's trying to take me off. There's no there, stay there. My model demonstrates this. So Ty is just saying, like, there's things like the acceleration of interest rates, where we're at in what stage of the business cycle we're at, what is the overall stock of government debt, and I'm going to also assume what is the overall stock of private debt, that there are many variables at play, and that any one of those variables might change how a sudden hiking of interest rates and what a sudden hiking interest rate would do to economic growth. What I would be interested in, and again, I'm not going to, I guess I'd like be pausing too long to read it all out, but my one thought would be, and Ty, I mean, just correct me if I'm wrong, but I'm assuming there are like behavioral assumptions that are being kind of baked in to the assessment here, and it does make me wonder. I just it makes me wonder if higher interest rates, like if essentially the Riddick-Goyle argument, right? There is no Fed in his video. If his argument is correct, and that higher interest rates, that higher interest rates are actually better for asset allocation, and that it actually encourages risk taking, as opposed to kind of the other way around, right? Because the kind of I don't want to call it mainstream, but like the standard argument is when the Fed lowers interest rates, one of the things that's doing is that's kind of forcing the hand of lenders, essentially forcing the hand of lenders that in order to gain higher returns, right? Because they're not getting any interest income on bonds, to force their hand to create loans to try and get interest. And I think my argument on that is, at least on the behavioral assumption side, is I think it's backwards, right? I mean, I think it's that banks are more likely to take risk if they have, what is an effective put, right? It's an effective hedge in the overall allocation of their assets. And they're getting that hedge because it's a direct injection of capital from higher rates. Now, granted, there's eventually a pass-through that will happen where depositors will demand some of that, right? But certainly if interest rates are at like 0.5%, there's not going to be any pass-through to depositors at that point. And banks are going to take that entire 0.5%. But like, I mean, even right now, yields are at, or the Fed funds rate is at a 5.5%. And I'm looking, online at the best deposit yield on deposits, and it's like 4.4, something like that is what I can find online. So that's a percent spread in and of itself, and it took a long time to get there. I mean, banks were setting on quite a lot of that for quite a long time. So, I'm interested to see how the dynamics play out, and behavioral assumptions are tweaked and all that good stuff, and the other thing too is I think in some of this, I guess I also don't know where I would look in the data to prove that out. I mean, there's some things that you can see, kind of cause and effect things you can see in the data when it comes to like government spending and how that affects stocks. And it's like, you see this correlation over 50 years worth of data, and you're able to detect causality, and like everything comes in exactly as you would expect. Then the theory's got to be true, right? It's logically true. You're not making too many behavioral assumptions that when the government spends, I mean, you're making any when the government spends, it adds net financial assets. But when it comes to what are the banks doing and why are they doing it, I think you're baking in some assumptions. So that's where the disagreement. I don't even want to say disagreement, right? I at least on my end, I could be wrong, and if it's able to be shown that, then so be it. And I'll unlike the praxeology guys, I will update my assumptions, move along, happily crushing markets, and count myself rightly and corrected. With that being said, I'm rarely wrong. You can ask my wife, man. Maybe once a year. Am I wrong? Jango, you're both right. Yeah. All right, moving on. You can actually see this in the Minsky model on YouTube. I recreated the same model on the video. Yeah. I gotta figure out how to put Minsky together. All right, chat. What else? All right, we'll go. Actually, you know what I really want to do. What I was kind of intrigued about. I'm just gonna do this. What I was a little intrigued about here is there was this kind of time period in the 60s where we never really got like a strong acceleration event. And maybe that was just the nature of what was going on. So let's see. Let's change this to billions of dollars. Yeah, I probably should do this as a percent of GDP. So I said 1960s, this time frame right here. Let's go Fed funds. Just a little curious as to what was going on in the 1960s with Fed funds. Steady but growing Fed funds. Okay. Interesting. Relatively low, but steadily growing. Okay. Then we had some wild swings. All right. Just kind of cooking things up. Just trying to see what might be there. All right, let's go back to chat. If you look at the model, you will find the key parameters that drive the cyclicality are the aggressiveness of investors and the capital output ratio. Okay, I will keep that in mind when I finally start building it out. I got to rewatch and really write down everything. But you made a really good point after I thought about it in the context of the Model 2, because banks lend based on DTI and SLR ratios, yes, and higher rates increase bank equity. If you run the model in Minsky, so you can conclude that higher interest rates help banks meet their SLR criteria to make loans. Yeah. Again, I think there's just a lot of variables at play. And you are also right that portfolio managers and investors are more aggressive in higher rate environments. Yes. You ask for a miracle, I give you the FOMC, Hans Gruber. Yeah, Hans Gruber is the bad guy in, or the antagonist in what movie? Die Hard, right? I'm right, man, right? I'm gonna look this up. Hans Gruber. Yes, okay, that is Alan, played by Alan Rickman, right? Yeah. All right. I was born slightly after this movie was made, but not too much. I watched the Die Hards though. Good movies. What else, chat? What else? Jango Geek on that point. In Dodge's money cycle, I do believe that there needs to be a relative housing shortage. All right, that wasn't for me. So while the higher interest rates don't cause a cyclicality, it'll be cyclical even without debt. They are still relevant to the consideration. Yeah, I like that. So I think that Doug and Keen are both right. Yeah. Good. Sorry, Chad. I'm just, as Doug indicated in a statement about behavioral, yeah, Jango Geek, you are correct. This third state variable. All right. It looks like some back and forth on that. All right. What else can we talk about tonight? What do I want to highlight? I think I want to just linger for a minute on some Twitter highlights from the past week and kind of elaborate on some of these. So last week I tweeted out on Peter St. Onge that evidence matters. This is why data matters. Go look. Well, okay. Actually, I'm going to start here. The main argument right now is that deficits are unsustainable. And this is kind of the biggest macro concern that everyone has had. And what I want is an example of a nation that this has become a problem in. And I need to compare apples to apples here, right? So in other words, like a lot of the comments immediately went to like Argentina, Venezuela, but I'm in complete agreement. If the U.S. tomorrow started issuing debt in euros, right, that we were gonna promise to pay back euros, and to get those euros, we printed U.S. dollars and then purchased euros, right? If that was the play, 100%, I would be in agreement that that's going to be massively inflationary, right? That's not good. That's not a good way of doing it. So the U.S. doesn't do that, right? And then it's like no surprise to me that Venezuela and Argentina and other nations that do this are inflationary, right? Or if you peg your currency to something, again, I mean, you're effectively you're forcing your hand to do the exact same thing. Not surprising at all to me that is going to be inflationary. So I need a country that issues its own currency, collects that currency back in taxes, and then doesn't peg or back its currency. Like, can I get an example? And guys, this was a very sincere ask, right? I'm just a simple guy. I don't know very much, but I hear about this all the time. I mean, everyone, that's unsustainable. That's unsustainable. It's unsustainable. This is like, it's about 40 years, 50 years, 60 years, 100 years. This argument's been going on. Like, there's got to be just like numerous examples out there, right? Just dozens at least of just nations with this unsustainable debt problem, right? And so I'm waiting. I'm waiting for the example of this terrible situation that is apparently going to play out. And I mean, all the examples are exactly kind of what you would imagine. Although there were some really good posts. I'm like impressed with some of the stuff that people posted back, and I do appreciate. There was one post I gotta find it somewhere, buried away in here, where somebody actually did post a really cool article that looks interesting about kind of certain debt events that took place that I would be interested in reading. But man, it's just. And then as I was doing this is what really got me. As I was doing this tweet, it dawned on me that, and if I stretch this back, I wish I'm not prepared tonight, but so this is inflation adjusted deficit spending, right? Change in deficit spending. But if, for the majority of the 1970s, which mind you, was the inflation decade, right? For the majority of the 1970s, we were in contracting or decelerating deficits, right? So the majority of the decade that saw like the worst inflation event that we ever had occurred while deficits were contracting in inflation adjusted terms. Now, I realize it's kind of a little cheating because I'm literally using inflation to denominate the metric that I'm using, but still, even if I did this in nominal terms, we were not exploding in spending at that point relative to what would come after, right? And we had massive deficits as inflation started to cool down throughout the 1980s. So I have an example of the U.S. I actually have the example of two very inflationary environments, right? 1970s and 2022. And during both those times, we had contracting deficits. We had effectively surpluses in real terms occurring during those two time frames. And it was massively inflationary. How did that happen? I don't know. I bet it had to do with the fact that in the 1970s, oil was very expensive and low in supply. And I bet in 2022, it had to do with the fact that we were off the back of a first global pandemic in a century and a major commodity producing nation invading another nation and therefore ruining its ability to export to the rest of the world. Huh. Yeah, I bet that might have had something to do with it and not the whole deficit thing. So, Yeah, I found that kind of silly that as I was just doing it, that like the example they could give completely undermines the argument that it's going to have some sort of inflationary outcome. All right, let's see what chat is up to. Are we? Does anyone want to timeshare AppliedMMT Pro? What else is going on, chat? I don't know. If I need to get caught up in something with chat, make sure you at me, and I will take a look at that. What else did I want to hit on tonight? Yeah. What am I? Oh yeah. Here's another tweet that I don't know, chat. Maybe you guys can help me out and figure this out. Divergence. A handful of people posted this recently, and I just don't understand what's going on here. Divergence between job openings year over year, and is that S&P beating estimates per share year over year, or is that S&P estimates year over year? So there's a correlation here, and effectively the blue line must mean some sort of profits, and they're saying that profits are going to lead job openings? I don't know. Everyone's okay. What is my? I'm not going to rip on them. Divergence between improving profits while demand for hiring continues to contract. Support to productivity and margins in the short term. Positive for hiring ahead. So they're saying hiring's going to kick up here. Okay. I don't trust a thing Bob Elliott says. I guess this just isn't making sense to me why this is important. But I saw it all over Twitter. No, chat, talk out loud. I want you to talk out loud. Just make sure you at me if I need to pay attention, or if you have a question, and we'll definitely engage. The next thing that I might want to hit on tonight. I don't know, chat, if I should code or not. I'm seeing viewers dip off, so I don't know if that's just you're here for the start and it's just bedtime. Or what? But one of the things I'm going to work on, I guess I'll show this. I'm one of the guys that does this really, really well. We talked about this a couple weeks ago, and this is Buffo Bill posting the federal employment tax receipt data and just showing that there's been a strong surge in tax receipts. And this is question. Ooh, this is a good question. I'll come back to tax receipts in just a second. Bob v. Doug debate. When? Yeah. Hopefully Bob and I can have another discussion soon. I'm curious. I appreciate Bob's take, and I don't appreciate his take. I strongly disagree with his take, but I at least appreciate his willingness to not be a pair Byland and question his assumptions, all that good stuff, right? I mean, we can at least can appreciate that, but it really, I don't. I mean, there was definitely a handful of years there where I think I was very stubborn and just kind of buying the eventually argument, right? I mean, to a certain extent, I think we're if markets didn't take off right away or things went against me out of the gate, say 2023, maybe I would have been like, okay, markets can diverge from reality for a while. But I mean, you'd think at some point, right? I mean, the main Austrian argument, which I loved, someone posted this, the Simpsons meme, say it. We're going to become Zimbabwe, and then everyone's laughing at them when we have it, right? I mean, at some point, you just have to say, hey, I was wrong. And why was I wrong? Like, it can't forever be I'm only wrong because everyone doesn't realize what I realize. I mean, I guess it can, but so yeah, hopefully we can have a discussion. And I can probe away and see if he's willing to admit that maybe we're onto something. I think too, I'm gonna hang here for a while. I'm gonna linger here for a while. I get this. This is very frustrating in the Twitter sphere, right? Because I'll say something to me that is just patently obvious, right? Government spending adds net financial assets to the private sector, right? To me, that's patently obvious. And the retort is not, no, it doesn't. I mean, occasionally someone will say, no, it doesn't, right? But the retort isn't, no, it doesn't. It's, well, this isn't good. Or, well, it's inflationary. Or, yeah, but it's, I mean, the best ones, at least some of them are getting it. The best ones are, yeah, well, it's stealing real resources out of the private sector, right? And that's always the retort. What about, the whataboutism? And I'm like, yeah, I agree. I don't disagree with any of the potential outcomes of it. Well, all I'm saying is the consequence of government spending is net financial assets are being added to the private sector. Why are people so quick to jump from a macro assertion that is just obvious, right? That just has to be true to these like pet micro. What someone tweeted this out at me, and I thought it was really good. Micro complaints, like they're these like micro, like I just don't like it. Do I have to like it? I don't. It's just what it is, right? And I'm gonna make my decisions accordingly. I don't disagree that when the government spends and it takes assets out of the private sector into the public sector, that's always a good thing, right? I don't disagree that a small nation that produces very little and has very a weak private sector, that if it starts printing out the wazoo, that it's going to have anything to even provision itself with. I'm not disagreeing there. But even the smallest nation that has nothing to produce, when it prints money to buy the resources in the private sector to provision itself in the public sector, the math and counting of that is that it's adding net financial assets to the private sector and the consequences that follow of that. And if you're an investor and you're a trader and you're making some sort of assessment of markets and you think that that's like somehow backwards, you're only lying to yourself at that point. Knock yourself out. Go invest opposite, short the dollar. See how that's worked out for you since 2008, right? I don't, and then don't tell me, oh yeah, but Bitcoin or gold, yeah, those things are going to go up. They're assets. There's more money in the economy. It's going to raise the price of assets. That's been my whole point of this entire endeavor. God, listen to me. Not you guys, chat. You guys all listen to me, but the rest of you who like what about? Yeah, I agree. Invest in assets. Stop saving in the country's currency. That's a bad idea. That's the whole point of it, man. It encourages investment. It encourages spending. It encourages growth. Spending is income for the next person. Sorry. Sorry. All right. I'm going to write that down. That is TikTokable. that is absolutely TikTokable. When did I do that? 55 minutes. I'm done. Need a Snickers. Yeah. I need some food. Maybe I'll get some food. Oh man. I'm a lifelong keto diet guy, right? So I'm on the keto. So I'm not going to have a Snickers, but my wife bought some like organic, whatever, range-free eggs, and bought some Irish cream butter. I had the best eggs I've ever had tonight. It was delicious. So I am happy. I was a little grumpy this morning though, but I'm happy now. All right, let's get back to chat. We'll get back. I saw some ats for me. We can always cover the meaning of life again. Yeah. Good draw for the stream. How did I get into this? What's my story? Cool question. I appreciate that. My story is, Actually, I've always been fascinated with economics. I've always been, I mean, even at a very, very young age, my stepdad, when I was 16, so my parents got a divorce pretty young. I mean, I still know my dad and part of each other's life, but I grew up with with my stepdad in the house for the most part. He actually, he was an accountant that eventually started his own advisory business and had a lot of assets under management. So we understood that for about 10, 15, 20 years maybe, where he ended up running that. And so I was always fascinated with markets, and we would talk markets. And he's very much kind of a neoclassical monetarist, Milton Friedman type guy. But we would talk markets. And actually when I was 16, he gave me $500 to like invest. So that would have been, I would have turned 16 just as like the .com bubble was blowing up. But, very early age, really interested in how markets work, and just kind of, I mean, I've always liked strategy stuff as well, right? I mean, I've liked games and all that sort of stuff, and I've always wanted to know how markets work. And fast forward, go to college. I went to a business school and did the econ stuff. I actually went to really would be kind of like the most Austrian. I mean, in fact, if you look up like Austrian schools, short of Mises University or wherever they have, I went to the most Austrian leaning school you could possibly go to in the entire nation. We interacted with Hayek, we interacted with those, and I mean, it was all that stuff. I mean, it was somewhere between Milton Friedman and Hayek is where I went to school. I was not academic. I mean, I still to this day, I just don't have I'm not good at school. So I was never going on the academic path. I enjoy tinkering way too much. And once I scratch the itch, I move along and build the next thing. So, but I ended up getting my degree in business, and economics was part of that. And I was very much in the Austrian camp. And again, I loved investing, and I really just wanted to understand, kind of make the macro case for how to actively invest with kind of an Austrian lens, and so I started building this out. Now the other thing that happened too is I mean, I was quite the ladies' man back in the day, and I mean, as you can see with this good looks that still exist to this very day. But the reason I got to bring that up is my now wife and I, when we were very early in college, ended up having a little surprise, and so life just had to go at that point. I had to start my career and put to the side any sort of anything else I had to get going on. And we kind of started our family very, very young, and so that just kind of pushed me right into the workforce. Never had the opportunity to really go into economics directly, more finance directly. And anyway, still though, it's kind of like a side project. Still trying to understand this and build this up as I kind of just worked a normal 9-to-5 that I kind of had to at that point. And for the record, she was my girlfriend at the time. We ended up marrying happily ever after. It's great. We have 4 kids now. It worked out all really, really well. But still kind of in the background, I'm trying to figure out how to build this kind of macro worldview, this kind of applied Austrian worldview to markets, so then I can hopefully find some sort of exploit, right? Because my thought would be, and they would kind of disagree that this has to be the case, but I think it logically follows that it should be the case that if there's some major if the market doesn't understand something, then there's something to be exploited there, right? I mean, if there's some outcome that's inevitable because the market doesn't understand that outcome, there's like you can just game theory it and eventually figure it out, right? And to me, there had to be some sort of kind of macro edge you could get from building some sort of applied Austrian approach. And so I started going down this path, and probably about 2010 to 2012 is maybe about when I'm trying to piece this all together in an applied way. And I really, really admired Bob Murphy. I mean, I still to this day, I don't want to say I don't anymore, but Bob Murphy was my go-to guy. I really liked the way that he kind of brought Austrian content into kind of a way that I could understand it. And, he just had good takes on kind of what was going on and kind of pop finance macro culture. And so I was listening to a ton of Bob Murphy at the time, amongst all the other guys in the Austrian world, trying to piece together the whole macro process. And and it was, and again, it's not, I mean, this is now 2012-ish, 2013. And it's probably 2013, 2014 is finally when I run across the Bob Murphy, Warren Mosler debate. And I'm like, okay, this will be good. Because one of the things too, and actually this is kind of what I want to do with this, continuing with the live stream is the best part, the easiest way to learn is for someone who kind of has a good understanding of how things work, talk through someone else's understanding, right? And kind of critique it, right? Because then, it helps solidify understandings. And Bob did a great job of this. And so he had this debate with this guy, Warren Mosler. At the time, I was a gold bug. Yeah, that's a good point. I was a gold bug. We had $12,000 worth of savings when I was in 2008. So what would that have been? I would have been 24, I think, at the time. Yeah. We had, I think that was about the money we had. And I was so bought into like the Peter Schiff narrative. I stuck every dollar we had in gold and silver. And I had like that in a safe. I mean, I honestly had, I think I had 7 ounces of gold, and it must, whatever the rest would have been, in silver. I mean, it's kind of cool. The silver bars were pretty sweet. I mean, a gold ounce is very heavy. It's kind of wild. But yeah, I mean, I was absolutely, and it just so happened too on the gold investment thing. It just so happened that I think we wanted the money for a down payment or something. I don't know. It must have been a down payment. So I bought in the summer 2008 at gold must have been, I think it might have been only like $700-800, but I think I bought physical gold. I wasn't investing at the time, like in terms of like I didn't have like a trading account, like an active trading account at the time. So I bought physical gold at like kind of the local gold dealer, and I probably paid just under $1,000, and I ended up selling it. I think if I'm not mistaken, there was like a big crash that happened in September of 2011, and I think I went the week prior to that crash and sold my gold for, I don't know what the percent was, but yeah, it just was literally my wife. I think we used it for the down payment. It must have been, but anyway, it doesn't matter. I ended up selling it just because we ended up wanting the money, and part of that too was. I also at that point then did start actively trading. When I sold that in 2011, that's when I started getting into realizing that, okay, maybe I could get some leverage and stuff. So anyway, we're at that point. I listened to the big. The other thing I was trying to do too, this tie into my other passion, which is gaming. I was also trying to build like an active economy script plugin for Minecraft that like allowed like an economy to run. Because I thought, what Minecraft is kind of missing, or I was really into Minecraft at that time. Like what Minecraft is missing is like an economy to constantly like make you want to go back and do the repetitive tasks in Minecraft and like get something out of it. And so I was trying to also build up like a framework so I could write some sort of script plugin to do like an economy like that. So fast forward, I listened to the Bob Murphy, Warren Mosler debate, and dude, it's like Paul road to Damascus, scales off the eyes. I mean, everything just opens up because Warren Mosler. I mean, at the time I had enough knowledge about the macro space, where I was able to track what Warren Mosler was saying, and I just it literally changed my life. I mean, right then and there, I'm like, holy cow, what he's saying makes sense to me. The other thing too is what he was saying was immediately testable. Like I was able to come up. I think that's really what it was. I look back on it. His whole idea of what government spending was. So it was that debate, and then I immediately listened to. He had a lecture series. God, it was in a big lecture hall. If I recall, it had kind of that salmon. There was like salmon pink behind him. Him, Stephanie Kelton, Randall Ray were all there. It was really well. It was like a modern money thing. It was really well put together. And I mean, I immediately listened to that. I didn't know who any of these people were, but they kept repeating this line about what the implication was of government spending. Net financial assets, all that sort of stuff, right? So that was going on, and I'm like, this is immediately testable. And I think I listened to all this within 24 hours. and I'm like, this is all immediately testable. And so, I was able to just pull the data right away and test it, right? That they're immediately realize there's some connection here, right? You start to see a correlation. And at that point, when that clicked and I knew this could be the key to kind of cracking markets, it was done, right? And I didn't feel, my detractors will say that, you just like what did Pierre write the other day? Like, people find something that they, essentially scratches their political itch or something like that, and then they go along with it. That was, it was 100% the opposite. I was very, very far from a lefty. I can't tell you how far from a lefty I was. This is why I think this is probably why Bob wants to make sure I'm not gaining too much traction or anything. Because I really am the right. I shouldn't say the right. I really am kind of the hard money, that economic school of thought worst nightmare, because like I homeschool, I have 4 kids, right? We do the homestead thing, we live in a small neighborhood out on the countryside. She's not my wife stays home. I have a trad wife, right? She's not like a trad wife, but you get, she has her own autonomy, but you get what I'm saying. I'm their worst nightmare, because I still accept the fact that when the government spends it, adds net financial assets to the private sector. But at that point, it dawned on me that that government spending adds net financial assets to the private sector, and it took me quite a long time. So I started this channel. In 2016. Actually, I think it's going to be my 8-year anniversary. And in fact, if you look at the initial video I had, my call in that was spectacular. It was spot on. It's so wild. I've learned a lot. I should probably take those videos down. Because I've learned so much since then. But yeah, my call out of the gate was great. So anyway, I start merging in the MMT stuff. And at this point, I don't think I was like necessarily like an MMTer per se. And I never, for the longest time, really until kind of AOC popularized MMT, and I knew I could like get some traction with the MMT, namesake, that I even care to change this to AppliedMMT or MMT, have MMT in the name. But I slowly incorporated that understanding and put that understanding into the broader makeup, and I guess you could say kind of the rest is history. So I continue to build out the framework. And eventually, a couple years ago, I started to understand how to program deep learning. And Jefferson Spatchcock, what is going on? Now that is probably the biggest name I've had in here. What's going on, buddy? Return to the gold standard. Yes. God, this is so good. I'm so glad you dropped in, because one of the pieces I'm missing is a good friend of mine whose name is also Jeff. Let's see. Give me a second here. A ton of chat has gone by. A good friend of mine, whose name is also Jeff, encouraged me as I was getting into this again. This is probably 2014, 2015, to read this crazy guy out in Australia named Steve Keen, to read Steve Keen's stuff. And he hands me, this is how Steve Keen comes into this. He hands me a Steve Keen article. And I remember the first time that I looked at the Steve Keen article. Jefferson Spatchcock is a good friend of mine, and I am indebted to him. Let's just put it this way. So anyway, this friend of mine hands me this article about Steve Keen. I was so naive at this point. I'm like, this stuff made no sense to me. The Steve Keen stuff made no sense to me. But he kept pressing it a little bit, and I think it was just an article that Steve Keen had written many, many years ago, just about how government spending doesn't work the way that the mainstream thinks that it works. And lo and behold, eventually I would watch like a Steve Keen video on what happened with the Great Financial Crisis. And once that happened, right, like once I had that understanding of what Steve Keen was saying with endogenous circuits and on the endogenous cycle, and what the government was doing with spending, creating net financial assets, it was game on, right? I mean, it was absolute game on. I felt like I had a complete lock on markets at that point. That's not to say like every trade went right, but for the most part, I felt like I had a pretty darn good understanding of what was going on. And then again, a couple years ago, I started learning the deep learning stuff and learned how to take kind of the moderate data science background that I have, and then just apply that to the deep learning and bring that into the deep learning models. And that's where we're at. I mean, that's where these deep learning models are at. And then about a year ago, the AppliedMMT guys are like, "Hey, you should join us, and we can help you, help us." And it's been that's kind of where we're at now, and hopefully into the future, we can continue to grow this thing out and eventually start a fund and kind of just. I still think this is a way like MMT is going to win, whether it's myself or someone else that finally is able to demonstrate the ability of MMT to just crush markets, then I mean that's how it's going to win, right? And I hope I will do my part to hopefully be that person. But that's kind of where we're at, and that's where the deep learning stuff is at, and that's kind of how we got to this point. So it was a very long discussion, not shortable, but a really cool question, and thanks for kind of hanging in there as I went down memory lane. All right. I'm going to catch back up on chat here. Doug, can you please go over why higher interest rates incentivize portfolio managers to take on more risk? Asking for a friend in chat. Jango. Yeah. I mean, effectively, the best way to think about this is that if you are portfolio managers have like a certain target that they have to hit, right? They have to hit like some sort of return target, and then usually they have to hit some sort of volatility target, right? So they can only have so much volatility in their portfolio, and they can only have so much, take so much risk. And if they have too much risk, they have to pare down that risk because they can't have so much volatility risk, right? And they also have to hit like 7% return. That's it, right? So if that's you, and particularly like the volatility portion of it, right? Like they have to have a volatility target. You can't, if you're not getting something for free, right? You can't take, how do I put this? You can diminish the effects of volatility on your portfolio if you are just getting free returns on part of that portfolio, right? And, if you need to hit your 7% target and the government's just giving that to you on like half your portfolio, right? You can maybe run a little leverage on that half of the portfolio and hit your target just by that. And then you can take as much risk as you want on the other half of the portfolio, right? Because it's not going to hurt you at all. Even if everything goes bust, it's not going to hurt you at all. You're still hitting your target, and your volatility stays in check because you're not having the volatility effects from they're being offset by the interest income. And so it actually allows, and Riddick Goyle is the one you want to watch. It's an hour-long video. I gotta watch it again here soon. I'll pull up the Riddick Goyle Fed. This is the hold on one second. All right. Let's see. This is the video right here. The Fed does not exist. This is a video you want to watch. He's explained it in great detail as to why asset allocators actually prefer higher interest rates, or not that they prefer, that's a bad way of putting it, that you can actually increase your risk exposure with higher interest rates. The Fed does not exist. Riddick Goyle. But I think my summary is pretty good. All right. Let's see. What else do we got? Oh, we got Chris saying he was a gold or a silver bug too. Yeah, man, silver. Coming back. Charles Grip, that was Oh yeah, if there was a game with a solid economy, that would be exciting. I guess that is to a certain extent life. Jango, that's the way to go too, man. You want to just buy, hold, manage from there. If we ever have a 2008 scenario again, you should be able to see it coming. Question: key to cracking markets so you don't believe in random walk theory. No, I think on almost every level. I don't know. I'd have to. Let me pull up like the random walk theory. Random walk theory suggests that changes in asset prices are random. That means that stock prices move unpredictably, so the past prices cannot be used to accurately predict future prices. Random walk theory also implies the stock market is efficient and reflects all available information. A random walk challenges the idea that traders can time the market or use technical analysis to identify and profit from patterns or trends in stocks. Yep. Going to disagree with the random walk. There's part of me that says, like the game theory part of me, the game theorist part of me says that, like, yeah, to a certain extent, there should be no ability to defeat markets, like, right, that they were all just guessing, and that part of it I don't disagree with. And there's also part of me that says too, let me put it this way, right? If we lived in a world that was purely endogenous, right? We had a purely endogenous cycle, right? There's no government spending per se. It's a purely endogenous cycle, and this thing just cycles over time forever and ever and ever. And we always just have these booms and busts, and everyone knew about that, right? Like we all understood the cycle that was taking place. Then all that would happen over time is that we'd all just be speculating on stocks. And what drives like speculative patterns is human behavior, which in and of itself has its own emergent properties and dynamics at play underneath of it, right? That could be explainable, but not necessarily predictable. So if like that was the world that we lived in, then yeah, I agree that we'd be in a random walk sort of world. And I don't think you could ever anticipate one asset over the other per se. So I'm qualifying this to say I could make a case for random walk theory. However, it's very, very, very clear to me that all information is not, that prices reflect all information available. The reason I know this for a fact is because you can run analysis on government debt, Granger causing S&P 500 returns. Does this mean that government spending causes S&P returns? No. But what it does mean is that S&P returns are forecastable at a certain time lag, are forecastable with the additional information of government spending. If we had a true random walk, you would never be able to detect forecastability from one variable to the other, because by definition, under a random walk, price always reflects all available information. So it'd be instantaneous, right? And so I can conclude that random walk can't be true. That would be my argument. So yeah, I disagree. I would disagree. Good question. Just a reminder, chat, put at me or question in chat if you want me to hit you up real quick. All right. Next up. Yeah, Chris, glad to elaborate. That was good. Question. Isn't MMT just a free lunch? I mean, it's a free lunch for somebody. It's a free lunch for somebody. Yeah. Let's see. What else? What else is going on? Another point from Riddick's video is that people already can access the bank loans, aren't affected by rate cycle anyway, which I think will cause the shadow banking system bigger, make it bigger. Another point from Riddick's video is that people already can access the bank's loans, aren't affected by the cycle. Oh, okay. Yeah. I get what you're saying. That higher rates aren't precluding more people from more loans. Yeah. I forgot those assumptions from uni. Yeah. I oftentimes have to, embarrassingly to myself, relook stuff up. Free money, as in 0% credit cards. Free money. Granger cause being over your head shouldn't be over your head. It's pretty simple. It's just forecastability. It's actually really, it's like amazingly simple now with all the tools available. I think that is kind of one of the coolest parts to all the stuff that I do. I've been teaching Adam a little programming, and it is still it excites me every time I find some time series that I think should correlate, and then I find some forecastability between them. Like the whole causal inference endeavor is just a lot of it's a lot of fun. All right, I think I'm caught up on chat. We're pushing 9 o'clock here, but viewers are still around. We're pushing 9 o'clock. Let's see. What do I want to do? I'm at least going to talk this through, and then talk through taxes. We went over this a couple weeks ago, how higher taxes. Yeah, chat is popping, man. I'm glad you guys are having fun. We went over this about taxes. Okay. So when you look up deficit spending in not deficit spending, when you look up the credit cycle, like the BIS data, actually this came up in the discussion that I had with Steve on Saturday. When you look up the BIS data, it's like so lagged, right? So I mean, in theory, you're dealing with, like, you're just getting, would that be 9 month old? Because this is 6 months lagged, and like it's a quarter, so you're getting up to like 9 month old data coming in late, right? So you're dealing with some very, very lagged data, and I'm gonna add bank credit to this too, and you can add like bank credit, and it's it's going to correlate pretty closely, but it's not the entire picture. Although look at bank credit start to accelerate. It's starting to accelerate. Right on track. So you get bank credit starting to accelerate. And why don't you use H.8 instead of BIS? So yeah, good question, right? This is why. I think bank credit is a more complete picture. Ty, you can correct me if I'm wrong here, but the BIS data is a more complete picture. And why I think that is, if I just do billions of dollars for both of these, it's like double the size. Total credit to the non-financial sector is 40 some odd trillion, and bank credits hovering around 18 trillion. And so I think the BIS data includes shadow banking. I think. And that's probably why it's more, yeah, I mean, it's yeah. So I think it's a more complete, picture. Ty, can you correct me if I'm wrong there? The BIS data would include like the offshore, call it non-domestic chartered bank data, right? You don't have to correct me if I'm wrong. So that's why I use the bank, the BIS data. But they're effectively the same thing. All right. Yeah, so they're effectively the same thing. And one is just a more complete picture. So where am I going with this? Okay, here's my thought, right? Is that if we were to isolate out the government spending, we just look at if we were to isolate out government spending, so what I would actually just say like is deficit spending, right? So the government never. I'm trying to say this in a way that's not going to contradict myself in a second, but whatever. If we were just to look into a purely endogenous cycle for now, right? And somehow you also had to pay taxes, right? And like the government was never spending, but you still had to pay taxes or something. I know it's really stupid, but just go along with me here, right? The immediate consequence of expanding credit would be higher taxes, right? You would see in terms of like the flow of taxes, if you will, would increase because higher or expanding bank credit means more business activity, right? So like when things are bought, you got to pay a tax on it, right? When you sell your asset, there's taxes to be had. When you pay workers, there's taxes to be had. So more economic activity means more taxes. And the problem with the data that we have is that it's, by the way, I just keep looking at this. I'm so happy to see bank credit continue to accelerate. It's a huge jump over the last few weeks. It just means there's more taxes. So we can Ghost on the Half Shell, man. I see also, it's really, by the way, I got to meet Julia. This was great. Oh, hopefully it's okay if I'm doxing you. But it was great to meet you Saturday. If I just doxed you and I wasn't supposed to, I'll edit that out. So where was I going with this? The taxes. Taxes should be, taxes should be tracking bank credit. And if you pull up, now I'm going to go, do I have that chart pulled up? Give me 1 second. If I pull up, tax receipts, lo and behold, I'm kicking myself. Ty, jumping on my mistake. You're not going to let it go now. If I add the time series, the bank credit time series, to the taxes, here's what you're going to see. And we do these both as a percent change year over year. Go line 1%, change year over year. We'll offset the separate access positions, and lo and behold, we'll zoom on in here. Taxes track the credit cycle. Taxes track the credit cycle, and so that's kind of the big takeaway. Is that we can possibly use taxes to understand how robust the business cycle is. And there we go. So Bill Wabuffo, Wabuffo on Twitter. Great follow. I'm sure if you're market interested, you're probably already following him. But he does this great job of tracking the taxes being withheld from the daily Treasury statement, and then compares those month over month. And I've been wanting to come up with a very similar look in terms of kind of tracking taxes, to kind of know what I really want is effectively like a real time track of this growth rate year over year, because I think that'd be very valuable to then use to predict the credit cycle going forward, right? And then when we can predict the credit cycle going forward, that will allow us to know where stuff's happening. Yeah. Let's see. So what I did is I pulled in, and I'll show this in just a second. Show you some of the work I've done so far. So I pulled in the daily Treasury statement, and I'll just show you some of the things that I've ran. Whoops. Highlight that. Pull in the daily Treasury statement data. You gotta it's really messed up. So you gotta run some pivot tables and change the way the data is actually presented to actually work on to get the table that you would want, which is this whole idea of like each record date has deposits, withdrawals, and kind of a net flow. So deposit like 90 some odd percent of taxes or of deposits are taxes. So for our sake, deposits is enough. And then here is the moving average of withdrawals. That's not what I want. Is that? Did I think I wanted deposits. I think this is deposits. I must have messed this up. But deposits is what we want. I can show you in a different chart. But suffice to say, I could never get it to where it was showing like what I question. Does Doug hold in ETF? What do you mean? Do I hold? Do I just purely hold? But I guess what I'm trying to say is what I was attempting to do is create some sort of like a nice smoothed out line for tax receipts, but I could never get it that way. It never panned out. It never was the correlation that I wanted. There was just, I think I was having like the base effect issue. So I think the way Buffo is doing it is the right way to pull it off, to do like a month by month, because it's really clear when I do quarter by quarter that and do just like a rate of change quarter by quarter, that we get the very strong correlation that we're looking for. So maybe next week, I'm starting to kind of hit that wall. So maybe next week, and we can program that out, and I'll have something ready to go. Ty, let me know what you mean by your question here. Does Doug hold? I don't know what that means. Jango, you're saying you went back as far as 2003 from the daily Treasury statement. Is that what you're saying? One of the things we got to do, and it's probably very doable. Yeah, okay. It's probably very doable with, I only pull back to 2005 because that's where the data stops at. Is they have the daily Treasury statement. Oh, you're saying for 2 years you added the daily Treasury statement back further from just like where the CSV file goes. Oh, okay, Ty, I get it. Yeah, I'll answer in just a second. Yeah, you can. So this will just be the project. We got to do this at some point. Give me 1 second here. I'm going to do this, pull back up chat. We're going to go daily Treasury statement. Yeah, so the published reports go back to the 1970s. And they're in PDF form for quite a long time, like very legible, like machine legible PDF form. So what would probably be cool is to go back to. Yeah, okay, that's right. So at some point, the daily treasury statement is like the whole freaking year. It's like just a massive 502 pages. I think it's 98 they start actually doing. Okay, 98 is quarterly. 99 is monthly and daily. So starting in 99, they have very legible, machine legible daily treasury statements that are consistent. So what we could do is there are Python packages that can machine read PDFs and break this stuff down. So I guess in theory, we could build a bot that does this for us and get us back to 1999. And there used to be a page. I don't know if it doesn't exist. The Treasury Department, whoever runs this is called Treasury Fiscal Direct, changed the way they structure all this. If you build the bot, please let me use it. Yeah. Probably the sort of thing I'd make public, or at least drop the data. Yeah, we could probably rip this data because I think bringing this back, it'd probably be nice to see what took place prior to probably 95. You get pretty good. You'd be able to kind of learn the implication. Maybe we'll have to do. Although I'd have to I'd always be worried. We could pay somebody to do it as well, but I'd always be worried that I've done stuff by hand too, like the monthly treasury statements I brought back to the 1960s by hand, and it's it's just so easy when you're just the monotony of it to miss hit something, to print something. I don't know where I'm going with this. Yeah. So anyway, let me show you this. Going back to taxes. I don't know what else I was going to show on that. I want to show you daily treasury statement. Yeah. All right. So on the daily treasury statement data over at AppliedMMT.com, this is really interesting. Is you had a massive swing in 2008 from taxes. This is nominal terms. This isn't even real terms here. Right? It's nominal terms. The 90-day average of tax receipts heading into May of 2008, just huge. And in an environment where credit is contracting. So what that means is we had a massive credit expansion into that point, and the taxes finally came in, and then a complete collapse at that point. So I think there's a way, and this is the 90-day average. So I mean, I think we could engineer this in a certain way to show something important here, and give us a good indication. And I'm sure if we brought this back to, say 2003, you'd see a very steady increase here as the endogenous expansion took place. So, and then there's this this inflection point where taxes do enough damage to outweigh or outpace any of the support that fiscal is having. And it's just classic kind of bracket creep, and that pricked the bow, and great financial crisis ensued at that point. Crazy that it was the April tax strain that really set things off into the abyss at that point. God, what a wild time. 15 years ago, right? Going on 16, 15, 16 years ago. Going back to Ty's question. Do I buy ETFs? I do. I buy pretty much an ETF. I accomplish everything I need through SPXL. And that is it. I've done futures in the past. I don't feel the need to right now, but certainly you can do futures, and then I will buy options for hedging to get those kind of asymmetric moves, and get that the tail essentially is hedging for tail risk. So that is yeah. The most interesting part of the Steve Keen and Friends episode with Douglas was the disagreement of housing was having a supply side problem. Yeah, I don't have an opinion on that. I don't know. All right, chat. What else we got? Yeah, I mean, everything I explained, Ty, on the everything I explained on the stream with Steve is, I mean, honestly, what I do, and I really think that buy and hold, and then just push for more exposure, and during kind of the best times. Ian, I'll answer your question in just a second. Push for more exposure and kind of the good times, and yeah, just ride the wave in the short times, or in the kind of nominal times is just the way to go. And maybe if I don't say unfortunately, I mean, I love what I do, but I spend a lot of my time preparing for everything we do here, doing this updates on AppliedMMT, doing my own research. So maybe if I had time to just only trade, I would try and do something more akin to swing trading and the shorter term scalp trading and that sort of thing. But man, at this point, I haven't cracked that code. Not from an effort, not from a lack of effort, and not trying. It was, yeah. I just timing's tough, man. Yeah, timing's tough. Maybe I just don't have the mental for it too. But I think the other thing too is quite a few years ago I came up with this analogy of trading's kind of like golfing. Right, you're out on the golf course, and there are just some holes that getting a par on is like everything you want. Right, they're just, you're not going to birdie them, but you can really royally screw up on that hole. Right, I mean, it could be a double bogey, triple bogey. Right, and then there are holes where you got to get aggressive. They're birdie holes, like, they're short par fives. You might be able to make an eagle. Right. And those are, like, to me, that's kind of what trading is, right? They're just time frames where, yeah, maybe some people are going to be like, oh, I got a birdie on hole number 13. Look at you laid up. And you know what I'm saying? You never even went for it. And it's like, yeah, like the last month has been that for me in markets. If I'm being completely honest, the last month has been like that for me. I have not, I took a hedge out at the beginning of March, I believe. And I mean, that cost money to do so. And so I didn't maximize the gains that I had been at that point. But, instead of getting a birdie, I got a par. And I'm okay with that, right? Because, like, I fucking crushed it in November, December, January, right? And half of February. And I'm okay. I'm okay with that, right? And, like, and the nice part is too, like, my game, I'm able to take advantage of the holes where the vast majority of people can't take advantage of them, right? Like, I mean, I feel like my game is like Tiger Woods in 2000, and my golf game. The analogy here, keeping the analogy straight, my golf game is like Tiger Woods in 2002, right? And I'm okay with that. So I look at the year is 18 holes of golf, and there are holes where you can really take advantage of the current situation, and there are holes that you just got to be careful on, and when it's all said and done, you're playing 18 holes of golf, and your goal is to be 4 or 5 under and give yourself a chance to win the tournament, so to speak. And to me, that's what I'm going for, is to eke out the alpha and the highest probability opportunities, and to just not get myself destroyed in situations where the alpha might not be there. And that yeah, I mean, it's just kind of how it plays. Good question from Ian. Would you use SPXS to hedge? So if I had like a basket of stocks that I like, right? If I was like stock picking, yeah, SPSX would be a good potential hedge in short run scenarios, right? So if I had Nvidia, if I had, I don't know, whatever, Apple stock, if I had whatever shrimp manufacturing company, whatever, whatever penny stock you like, right? I had a basket of all these different stocks that you were like really thinking, yeah, these are, and you like the stock picking thing, and you had some cash on the side. I mean, certainly one way you could hedge is SPXS. Yeah. I would also, and I to a certain extent, I don't think I ever shorted in 2022. I might have. I think I was in cash most of the time, but if another 2022 option comes around, which it will at some point, it would need to be something like 2022, right? We would need for deficits to actually contract, right? To go negative. By that I mean the change in deficits, right? So deficits really decelerating. I would just straight up short, but that would be what I would need, right? I would absolutely need deficits to be contracted before I just straight up short. Nothing else is going to get me to actually short in beyond just straight up hedging. I got out of that game. I got burnt. I think the worst thing you can do is short in a bullish market. I mean, of course, like that's really stupid for to say. Let me phrase that. Using the tools that I've built. So I'll show you the like the flow phase model, right? Which says we're in a bullish market right now, right? If flows are strong and we're in a market environment that's consistent with the highest return market time periods, and flows are strong, you can hedge in that environment, but you don't short in that environment. And even in like the next environment down, where you just have normal strong returns, not world-ending, record-breaking returns, but just quality returns, like where flows are certainly not contracting, but maybe you're getting close to the maybe you're getting close to the end of the cycle, but not quite there. Don't even short there. Maybe short in a time period like 2018. I think we were in a period that was pretty dicey. That's potentially shortable. But even then, I don't know. It's not necessary. It's just not necessary. Maybe it is. I don't know. Maybe it is necessary, or not necessary. Maybe it is possible, right? Maybe there's an edge to short there, but at least for me, I don't see it at this point. So yeah, SPXS to hedge. Very much. And if I were to ever just if a 2022 were to come up, or certainly obviously 28 or 2008 or 2000 event were to come up again, yeah, I'd definitely be willing to short, and that would be one way you could do it. What else do we got? Chat? All right, chat. Yeah, risk to reward is very important. The risk to reward, as well as just understanding your sizing relative to your sizing, your positioning, your sizing and positioning relative to where the underlying flows are and what the risk is relative to those flows. So, yeah, I would agree. All right. I'm feeling, how long have we been streaming for? Almost 2 hours. I feel like maybe I could keep going. I don't know. Maybe I should be done by 10. Let's go see what's happening on Twitter. God, do I do this? All right, let's see. Let's see what Twitter has to say here. See if anything catches my eye. Not a lot of chainsaw is coming for disability pensions, a 20-year-long mega fraud that cost Argentinians $2 billion annually. Frauds. Oh, here we go. God, I'm so glad I did this. I'm going to be streaming for another hour now. What is he saying here? All right. I haven't even read this yet, but I can tell. Oh, God. Lose my shit here. Give me a second, chat. Give me a second. Let me zoom in on this. Nassim Nicholas Taleb. You don't need one single simulation to see the ratio of financing cost is growing faster and faster, monstrosely. Is that a word? Monstrosely convex, with GDP growth at best constant or optimistically linear. You just need a pen and a napkin, and certainly a drink. Oh no. Oh no. Monstrosely. Oh no. This guy's an idiot, man. The great irony of this is all you need is a pen and a napkin to write some T accounts to realize that I think I'm going to give up. That debt, that government debt is someone else's asset. All right. All right. This is so dumb. But you know what? I'm going to take it. Do you know why? Because I've been crushing it for the last year because dumbasses like this keep telling people that they should stay on the sidelines. This is why I don't feel bad in the slightest for trading and earning income off of this. It's because it's this dude that I'm beating. He's so arrogant about it. All right. That's it. No. When the risk, like, this is what I don't understand. These guys have access to the same data that I have access to, right? The risk is not enough debt. That is the risk. The risk is not enough debt. Not enough public spending is the risk. And don't give me the stuff we talked about earlier, right? I don't want to hear it. I agree. If monstrosity is a word, okay. There's a few things I'm really, really not good at. Vocabulary being one of them, spelling being another. Y'all are telling me monstrosity is a word. All right, there it is. It is a word. Thank you, chat. What was I going to say? Yeah, here's the deal. Here is the deal. When the government spends, it's adding net financial assets to the private sector. That is how it operates. It has to be that way. There's no other way for it to be. The government can't borrow from the private sector because the private sector can't create those dollars for it to lend to the government to spend in the first place. Even if the government creates money endogenously, right? What's left is the asset, right? The government can't take the asset out. Is the tax. It has to issue its own currency, which it then receives back in form of tax. Okay, I'm going down a rabbit trail. I don't need to right now specifically. Let's see. I'm also getting some super chats in. Let's see. We'll go on my diatribe in just a second. First though, Jango Geek. I was telling this economist I follow that if the government pays off its debt, people like me and you would lose out on interest income, and he short-circuited. Yeah. It's like the tweet I put out the other day. They're like getting everyone up in arms just about like if you really are for small government, you don't want surpluses, right? Because that means you're taking wealth out of the private sector. And I don't know, maybe that's what people want. I'm not a conspiracy theorist, but maybe that's what they want. But it is mind-boggling. They do short circuit though. That's the thing. They just short circuit, and they have no way to wrap their minds around it. But yeah, thanks for the super chat, man. I appreciate it. Appreciate the engagement too tonight. That's been good. Yeah, Ty, I appreciate that as well. Thanks for the super chat. Let's see. All right, let me go on my spiel here, because I'm gonna have to. This will have to be one of the things I clip for the short, for the TikTok. Here's how this plays out, right? Here's how what Taleb is saying is just absolutely stupid, right? And when the government spends, it's adding financial assets to the private sector, right? And there's again, the math plays in no other way, right? And so the reverse of that, the inverse of that, is when the government is taxing or receiving more than it's spending. That means it's being financed. That means it's actually being financed by government deficits, and that's where the danger actually is, right? And like I was going to say, don't give me this whole what about inflation? What about runaway debt? What about this? What about rates? All that sort of stuff. Look. Or that you just don't like that they're doing it. I don't disagree that you might not like what the government is provisioning to itself, but as the data clearly shows, what you don't want to do is find yourself in time frames where deficit spending is contracting, right? Maybe you do. Let me take away any moral judgment from this. Let me just put it simply as, if you start reducing deficits so much to where they're actually contracting and we go into surplus, you will end up in a recession. It is an inevitability. It is a necessary condition for recession. So when Taleb says that this debt danger ahead is some sort of problem, and that this is known, from the pen and napkin, it's the exact opposite at this point, right? It's when the debt finally contracts, that's when you need to be worried. Now, if we isolate, and this is what a lot of people do, they think because of loanable funds and what have you, that government debt is the same as private debt, and they put them together. Now, if that was my view, I would understand this, but we know that it's not. And on the private sector side, yes, eventually this will become an issue, right? Where you will get the debt cycle to play out. But we're not close to that at all. Okay, I mean, just again, look at the freaking data. We're at the very beginning of the next cycle upwards. We had our blowout. So anyway, yeah, he's got it backwards. I don't know if that was clippable. Maybe I'll re-record that to make it more clippable. Douglas Dowell, thanks for an epic geek out on Steve's show. Yeah, I enjoyed it, and thanks for the super chat. I appreciate it. I had fun. It was good going on there. Like I said at the outset too, I can't figure out how to highlight people's names. I have an app that clicks and it allows me to highlight their name. I had a lot of fun. Like I said at the outset, oftentimes guests want me just to explain MMT, but I was in a group of people that already understood this, and it was nice to be able to go on there and kind of talk about the things that are really that I'm really kind of passionate about, that I think just haven't been expressed and explained enough in the space. So that was cool, and I just I'm very thankful to Steve Keen and all. For allowing me to kind of take the conversation in that direction. I'm also glad too that we got to talk about rate stuff as well, and kind of get some disagreements and That's always good too. So I think it's a great conversation, should be had. And I think the other thing too, and I know there's some MMTers who like hate the fact that finance ever gets discussed in light of MMT and stuff, but it's just, I think it's such a real-time way of understanding how to apply the knowledge you have, and I think those who spew just a lot of hate for markets. Listen, Ty, I'm not going to name any names, but if you drop some in chat, that's your thing. So anyway, I think it can resonate. The MMT message can resonate with so many more through this applied lens, and it's just so neat to see all this stuff play out in real time. And I feel like being able to explain some of the things that we were able to talk about on Steve Keen and Friends was able to get people to understand and watch things in real time. And you're able to kind of see markets play out, make predictions yourself, even if you're not betting on it, investing on it. You're still able to see this play out and have a rubric to understand how this all plays out. And I just think it helps the learning process for everyone. So, even if investing isn't your thing, and even if you wanted to get away altogether from investing, and I wouldn't necessarily argue that. Trust me when I tell you, it's not amiss to me that as I'm putting together these deep learning models and I'm spending time learning this just to beat the markets, right? It's not amiss to me that like that my time would be better spent to society, curing cancer, right? Like it's like a good point to have, but this, people engage with what I'm doing here, and it's educational and enlightening to a lot of people. So I sure am going to keep going this route. All right, next up. So yeah, thanks again for the super chat, Douglas. And thanks for reaching out to me on Twitter too, man. I appreciate that. That was a very kind offer. Thanks for the tip on the BIS. I'll definitely start looking at it more closely to get a sense of the Eurodollar now. Yes. Hold on 1 second. I got a good wife, man. She's helping out. Getting some stuff done. All right. Let's see. I think what the Austrians are saying is that the government is using scarce resources when it's spending, and too much lead to some sort of collapse. I'm gonna read this a little. I think what the Austrians are saying is that the government is using scarce resources when it's spending, and too much lead to some sort of collapse. Too much use of the scarce resources. Listen. And I said this on Twitter today. I swear I will never complain about an Austrian stance if that's all they're saying, right? But they're not, right? I mean, they are saying devaluing the currency, inflation. We're going to have Zimbabwe. I mean, that's what they're saying. They're not. If the argument was, it wasn't until Warren Mosler put the absolute beat down, the stone cold stunner. By the way, I really appreciate it. I wrote a line down, Ty, at the beginning. Ty, I'm right. I heard this right at the beginning of the episode. You said he looks like Stone Cold Steve Austin, right? I wasn't just thinking this, right? And so I wrote down a line. Let's see it. Ty, you put that right. Yeah. I guess I'm realizing. Okay. Yeah. All right. If you guys I was a big wrestling fan in the Stone Cold Austin era, and if you remember his King of the Ring speech that kicked it all off, right? I didn't want this to be too cringy and too obscure, but I wrote down this line to see if I could get it in. So if you guys, to put context to this, you got to look up the original Stone Cold Steve Austin line at King of the Ring, and so my line was, you quote your Krugman, you quote your Larry Summers, but AppliedMMT just predicted this market right, and that's the bottom line because Douglas said so. That was the line I wrote down. So if you remember Stone Cold Steve Austin, yeah, MMT 316 just whooped your ass. That was my line, but it never came out on stream. But y'all got to hear it tonight. So, poetry. God, wrestling was so much fun for those few years. Oh, it was so much fun. Those were good times. Those were good times. So, listen, my argument, I think, I think I'm in like moderate agreement, and I've gone over this before, but I'll reiterate. I'm not in disagreement that the government can be highly inefficient with the resources that it allocates to itself and uses and is provisioning itself. And I'm okay saying, like, I think a lot of political discussion should be had before the government says we're going to provision ourselves with X, Y, Z, or that we're going to essentially socialize or create as a public utility something, right? So I'm even willing to argue, like, hey, healthcare, right? I think it's a worthwhile argument to have that maybe we don't want a fully socialized healthcare system in this country, right? Or single pay or something, right? Maybe there is an aspect to a private healthcare system that's a benefit. I'm willing to have that argument, and I think that's the argument that has to be had. But it's so hard to get through these people that ever get that argument because they're so bass-ackwards on what the government's actually doing when it's spending, and that the spending in and of itself is not going to cause an issue. I mean, just as I was looking for, give me one nation like the U.S. that issues its own currency, isn't backed by something, and isn't issuing debt in another currency. Find one nation that's ever had some spiraling debt issue. They don't exist. It doesn't exist. It doesn't exist. That's not a problem. Now, I agree a problem might be that you put some sort of technology in the hands of the government that's not mature enough yet, and the government guarantees access to that technology, and it becomes a monopolist in that technological field, and therefore it precludes the possibility of growth in that field, right? It puts a cap on growth. That is a risk. No MMTer has ever denied that. I 100% agree with that. So what I'm saying is I'm willing to even go down the path of discussing these things. I'm not going to say what my opinion is on public versus private healthcare. I'm not going to say what my ultimate opinion. I want to keep this as focused on kind of the finance side, but it's debatable. I mean, it's absolutely debatable. Ty, thanks, man, for hopping in, and appreciate all the engagement tonight. I might still be on when you get back. Who knows? I'm on a roll. My wife just said she'd get the kids down to bed, and yeah, maybe we'll keep going. Maybe I will do some coding. So yeah, I'm absolutely willing to have those discussions, but that is the discussion, and all the other nonsense I think needs to drop by the wayside. And I agree. However, the one thing I'll point out, that needs to be understood is also on the flip side, the private sector is extremely wasteful, right? The successes of capitalism are built on the bones of many losses, right? And all we ever see is the winners, right? There are very few winners in capitalism. There's a ton of waste. But that's okay, man. It's part of the system, right? We don't know what's going to work until it works, and you got to try that out. And it's an emergent, dynamic system that's constantly evolving, and that's okay. And that's it goes on the ham shell. Yeah, it's not efficient. It's not efficient. It's actually very highly inefficient, right? But what it is it's highly adaptive, right? And it has the evolutionary capacity built into it, right? To constantly find a way to solve the problem. And that's a good thing. And for those who only find bad out of the private sector, I would also tell you, you're nuts. Get off your Marxist soapbox. Certainly the irony of these people doing this on Twitter. God. All right. I promised my AppliedMMT team that I wouldn't go down this path of bemoaning policy and politics and stuff. So I'll stop there. But yeah, I don't disagree. But no Austrian has ever expressed it that way. And when they start doing it, then that's fine. And then effectively they're MMTers, so we win, and they're on our side. Yeah, we got passive MMTers that just like to talk, but Doug applies. I appreciate that. Yeah, I saw She Watches, and then Doug has such a great voice. He's kind of hot. I appreciate that, Ty. My wife says I'm good looking. All right, let's get caught up on chat. Don't let that go to your head. Oh, the Stone Cold stuff. Yeah, I don't know. Too bad you never played Borderlands 2. Mr. Tongue is special. Okay. Borderlands. Yeah, maybe one of these days. I agree with the Austrian view, but I don't think most Austrians see the nuance. Okay. Yeah, I don't think they do either. Where am I at? People are way too distracted by whether the government can pay for it or not. Yeah. Yes. But the question is should, not if, but should the government pay for it? And what are the consequences of it? Don't see the nuance. Yeah, I think I can track that. All right. I'm an Austrian and an MMTer at the same time. I mean, okay. I think at various parts of theory, those are diametrically opposed, incompatible, but I'm glad. I mean, I'm glad you're here, at least, Charles. I'm glad you're here. All right, chat. What else do we want to do tonight? What do we want to do? Any other questions? I mean, I feel good. I still feel good. I'm willing to keep rolling. I'm trying to think. Just don't know if I have the mental capacity to actually code right now. Oh, you know what we were doing? And it worked? Is we were just scrolling through Twitter and we saw Taleb's tweet come up. So maybe let's scroll some more. Let's see what else we can find. You all right with that? Let's go. All right. Twitter dive hype. Yeah, Tom. Deep MMT overview. Ian, what would you like to see, man? I'm going to do... Ooh, Walgreens. Taking a hit. I might just scroll down. Sam Bankman-Fried. It's always mind-blowing in these situations. Like Sam Bankman-Fried and Elizabeth Holmes. It's like I mean, they broke the law, and I'm not like sad that they're in jail or anything like that. Okay, yeah, we can do a little bit of that. But I guess to a certain extent, like the people that buy into this stuff and the hype that gets brought around this, sort of like, what do you, Isn't that part of capitalism? Like, if you just make a bad investment, you just get burned. I mean, I don't know, to a certain extent, it seems like, I mean, anyone's, and I know they were doing specifically scammy stuff, right? I mean, they were doing stuff with, the money that they weren't, allowed to be doing, or, directly lying. But it's like, I just remember that scene where Elizabeth Holmes is on stage and with like Bill Clinton and, a bunch of other, Bill Gates, and everyone's talking her up as like the next best thing. Like, I don't know. That you just, I guess, if, yeah, it seems to me like there's like a bit of a scapegoatiness in some of that stuff, because the engine is always there to promote these people, despite like I mean, any biologist and physicist would have told you that everything Elizabeth Holmes was peddling was impossible. Right. Anyone who knows anything knows that Bitcoin is just it's just what do they call it? Like gold, right? Where you just, it's pure speculative, and you're just hoping that the next, that the price is higher, and there's a fool next to you willing to buy what you bought for more. Right. Like no one is. Yeah. Anyway, I'll digress. Let's see. Anything cool on Twitter? Come on, Twitter. Like, I'm gonna scroll a little bit lower down and scroll upwards to see if anything came out. I wonder what's happening in Argentina right now. I wonder how they're doing. I don't. Hey, here's the tweet. The U.S. debt outlook is fragile. Bloomberg Economics ran a million forecasts simulation. A show borrowing on what is an unsustainable path? Fucking define unsustainable path. What is unsustainable? Can someone please help me define unsustainable? What is an unsustainable path? And what's an example? What's an unsustainable? Yeah, I won't get into the. What? Can someone please help me define unsustainable? What is an unsustainable path? No one can seem to show me what this actually is. Just one example, please. All right, let's go back to chat. Yeah, I'll dive into Deep MMT in just a second. What about Austrian school and MMT school is opposed? Yeah, I mean, I'm pretty sure it would be credit money and hard money at the core of it. Would be where the disagreement is. Regarding the two, so that I don't think can be like worked through, and right, like they will forever be. All right, we can talk Deep MMT for a second, since that was quite the discussion piece on the Steve Keenan Friends discussion. Give me 1 second here. I want to pull up, while I talk about this, what was at least going on. always pull up the tweet. So DeepMMT, I'm trying to also kind of rack my memory in terms of how the discussion went down, everything I was able to cover, maybe anything I left out during the Steve Keen and Friends episode. But DeepMMT itself is a regression learning, right? It's a regression model. It's a learning model that is, God, I just saw that pop up in chat. Unsustainable is when the numbers are too big to fit on the check. Yes. As it. Maybe I got to read the article. Maybe the article explains what unsustainable is. Isn't it really peculiar, though, that everyone is calling for this unsustainable debt thing, and no one can give an example in history of this ever playing out? All right, so what are we doing with DeepMMT, and what the way this thing works is the best way to explain this. I guess I'll give away a bit of the secret. I kind of did on the stream as well, but there are two models that I've conjoined together, two structures that I've conjoined together that are trying to look at the dynamics at play underneath the hood. And it's really kind of a flow learning model, right? Where it's looking at the flows, and I can kind of list everything off, at least that comes to mind, right? It's obviously looking at deficit spending. It's looking at the endogenous cycle. It's looking at it as a flow. It's looking at things like GDP. It has inflation in there. It has each feature also inflation adjusted as well, because I think a lot of these flows in real terms mean something. So we have government spending. What else do we have? I do put the Fed funds rate in there as well, because I think it's important, a dynamic that's playing. And then how you end up doing this, right, is, so for example, you'd have something like this, total credit to private, to the private non-financial sector, right? So you have bank credit it's in the model, right? And then what you have to do is you have to understand each feature, that doesn't. How do you get the machine to learn the most from this? And then so what you do is you have to start to normalize it, right? By that, let's do this. Give me one more second. Normalizing data for machine learning. All right. This is a good little article right here. So the goal of normalization is to transform features to a similar scale. This improves the performance and training stability of the model. Common normalization techniques may be useful. Scaling to a range. It's in deep learning, there's what's called min-max, and there's certain things where you just kind of force everything into the same number range. So that would be so for example, total credit, right? You end up getting this thing where you get this almost like seasonality effects or trend effects or variance effects that play on the way the data plays out over time, and you want to remove those or give the machine the ability to understand that those are kind of noise or not important. And so what you do is you'd shove this entire time series between 1 and 0. And then you could also do a certain kind of function where you get a constant mean across the time series as well. And so what you got to do is you got to play with the normalization steps in data to get it to a point where the most amount of mutual information. So you're what you're trying to do is you're trying to get the essence of that feature, right? Whatever that feature is telling you about your target, you're trying to get the essence of that into the deep learning model by removing as much of the variance or noise out of that feature. And so a lot of the steps you're taking are to make sure that you're getting maximum mutual information between your feature and your target variable. The feature just being what you're putting into the model and what you're putting out. So there's all these different steps you can take. And it's just an arduous task. And even when you're done, you don't know if you did it right until until the deep learning model tells you that your outcome is better than it would have been had you not done it otherwise. And so you work through all these these feature sets, and then the other step you're going to do too is, okay, so like I'm almost positive this has forecastability. You can detect forecastability between credit and between forward returns. And that's the other thing too. God, this is the biggest secret of them all. I had a conversation with, I've had conversations, and this was the thing that I'm pretty sure even the big boys just kind of miss. I know they should know this, but the fact that the fact that we understand that this is kind of flows to like that you're dealing with flows, you have to go apples to apples, oranges to oranges on this. You need to make sure that you're constructing your target as a flow as well, right? Because we're measuring the impact of flows. You need to make sure that your target is a flow. And that is like my business partners knew I was giving that out. They'd probably be a little upset, but that's the important thing, is that you need to match flow with flow. And so what you're doing is you're saying, okay, each one of these targets, is it giving me mutual information about, or each one of these features is giving me mutual information about my target? And if it's not, that's okay. Is it informing another part of the feature, right? So in other words, inflation might not give me mutual information about stocks, right? There might not be some sort of forecastability with inflation in stocks, right? But if that inflation is in some sense enhancing the ability for one of my features to have even more mutual information or more forecastability with my target, then I'm maybe a little more comfortable including that. The risk, of course, is that inflation might just add noise to the actual model, right? And so the hope is, and the way you construct this model, and I mentioned this in the Steve Keenan Friends episode, is you construct it via essentially the combination of two different types of models. The first one being a model that tries to learn like the underlying dynamics at play, right? It truly is the part of the model that's trying to kind of learn the ordinary differential equation, Minsky like mathematical function that's at play, that's determining what price will be based on the various inputs. And then the second part of it is the time series portion of it, right? So this is the part of the model that does like the prediction part, right? It's actually saying like, okay, now I'm going to do my linear regression based on what this function is, and I'm going to spit out my prediction. And so you put these two things together, you continue to cook, and the goal is to hopefully end up with a regression prediction that makes sense. Now, I mentioned this during all the updates when we look at the updates on AppliedMMT, but every model, there's no surefire model, right? I mean, obviously there was, and and I was able to figure out every tick of the markets. Let's just say I'd be trading more than just a few times, making a few more moves than I do every year. But every model you have is going to have its strengths and weaknesses. And part of the way that I've constructed this, part of the strength is, one, it has an innate ability to understand the flows that are there and like what the outcome should be. But one of the downsides is you always have a base effect on these style of models, right? And that is always the trick, is you're always predicting from some point in time, right? And so one of the issues with deep learning models as a whole in this space is like, I could just predict like what the S&P price is going to be as opposed to some sort of flow of the S&P. But like if you do just a direct prediction, one of the issues you're going to run into is if you're reaching new all-time highs, that model has never seen that, the S&P can get to 5,500, right? So it doesn't know what's capable. And so oftentimes you'll see deep learning models really struggle to continue to make a prediction into the future because it just doesn't know what is possible, right? So again, another reason why you want to go from kind of flow to flow or change to change, and then reconstruct what that change would be relative to price, and then get like a discrete or actual level of the price. It's because that's the thing that the model can actually learn. So that's what Deep MMT is doing. And like I was saying, the downside is it's very, very reliant on what happened last year, because that's where the base effect is coming from. And one of the things we're building into Deep MMT 2 or 1.5 or whatever it turns out to be that we call it is a way to kind of hopefully smooth out that base effect, normalize that base effect, and come out with a few, maybe a bit of a range. Because certainly the last month has proven that Deep MMT can have down times. It can be wrong on the short run, but other than that, yeah, I think that is hopefully how it goes. So the model also gets trained. I will train the model when I start to see a lot of divergence between the model and price, and it will diverge because the underlying dynamics diverge over time, and that happens maybe every couple weeks, maybe every month or two. Or as long as maybe a month. And then from there, the data gets pumped into it daily, though. So it updates every single day. And that's the essence, man. That's the essence. Good question. Thanks, Ian. A while back, you showed a 3D colored graph, private debt ratio, public debt ratio, and the S&P and some other things. Was that, what was that again? I tweeted that too. I'll do this. It was. We're getting there. Here we go. This is the one right here. Yeah. Yes, it was the. Can I open this? No, it won't go any bigger. Private debt to GDP on one axis, government spending on the other, and then the change in credit on the other. And it just demonstrates, and this is really the essence, right? I mean, you could toss these three features into a deep learning model and probably get a very good outcome. But it just shows that, and then the heat map of this, right? Red means bad stock returns. I mean, it just shows that there's this inflection point that takes place when government spending dips and we go into essentially surplus, and you hit the end of the credit cycle, and it's not good for markets. And then the other thing too, with the other axis, it shows just how the higher the private debt level is, the kind of worse the outcome ends up being. So yeah. Yes. Ghost. I have the clip of Milton Friedman himself talking about losses culling the badly managed and poorly operated companies. His policies left us with today's timelines. Yeah, man. Post that. I call it a digital tulip craze. My chat's bugging out. Unsustainable. I got a definition of unsustainable. Here we go. Unsustainable is when the public sector crowds out the private sector. For example, look, every past civilization that is no longer around. Don't they call that confirmation bias? I don't know. But I don't just... so how could a simulation show when that point finally is? Right? That's just not... I mean, sure. That's how I would, I guess, define unsustainable. All right. 1 second here. saying you disagree. They're opposed about hard money. Austrian school describes a hard money standard. Economy and MMT describes a fiat. They are perfectly complementary. I don't think so. But Charles, I don't think the Austrian school has a framework for analysis for credit money. I don't think they understand that money is just credit. Unsustainable is when electricity goes out and we can't credit the appropriate accounts at the central bank. Yeah. That is when the debt is unsustainable. Yeah, Charles, I think the main thing that I would argue is the Austrians just do not have the capacity to incorporate and understand credit money. The framework just doesn't allow for it. Django, do you update that plot regularly? Whenever I need to post it for Twitter. Yeah, it is actually. So this plot became the phase flow model, right? So I eventually turned this into a predictive model. What I did is the target was max drawdown, the most recent max drawdown. And it's just a tool to understand what sort of risk we are for a drawdown. So yeah, that model gets updated regularly. I might have added a few more features to it, but the essence of it stays. The same. What up, Danger Zone? Is everything still proceeding as you have foreseen? Yes, yes. I gotta tell you, I'm eager. Not eager. I mean, I'm saying I don't want economic pain, but I'm eager for a bit of a bear market to finally come up. So people don't think I'm just a permabull, but I also don't want a recession. Uh-oh, that was a yawn. Ladies and gents. Yeah, unsustainable in business. I think it basically means unprofitable in business, but the concept of unsustainable debt is up for debate. I agree. All right, chat. I think this is it. If you got a question, go ahead and get it in the next second or two, because I'm hitting the wall. I am hitting the wall. I think that was good. What else do we got? Any questions? I think I'm good. Let's see. What is the weight of sparrow laden with a coconut? I don't know what that. If I don't know what monstrally is a word, how am I going to know it? God, today's Wordle. Do you guys still play Wordle? If you still play Wordle, I got lucky. Because I didn't know what today's Wordle. I didn't know that was a word. And I'm not gonna ruin it if you're gonna get your Wordle in right at the end of the day, but I didn't know that was a word. I asked my wife, she figured it out. She said close enough to a botanist, I guess. I've never watched Holy Grail. That was Monty Python, right? Yeah. Never really got into that. All right. I think that is it for tonight. Next stream. So we'll do the big Monday streams going forward, and then the next big. But we'll do some mini streams and kind of just keep cooking from there. So All right, crew. It has been a fun time tonight, but I'm going to wrap it up here. So until next time, good trading, everyone. And then we'll see you next time. Have a good night, everybody. Bye-bye.